I mean, this chart here is probably one of the most important charts, and I probably haven't explained it too well. So what I'll do is I'll explain a bit about how the debt security market works, and then this chart will make a lot more sense. So you have two things. You have T-bills and T-bonds, or sorry, T-bills and T-notes. So very quickly, a T-bill, again, this is going to be very big picture stuff here. A T-bill is how they raise money on a short basis. So let's just say less than a year, and they'll have several, the terms could be 2 months, 6 months, etc. And so we're going to largely ignore that. And when people talk about US borrowing money and blah blah blah, really what they're referring to is the US Treasury bonds, otherwise known as a US T-note. So effectively, what a US Treasury note is an IOU. And I used to explain all this stuff loads in the past, which is probably why I haven't bothered, because I sort of just go, oh, watch the videos. But I'm aware that, yeah, so we're going to ignore that. And we're going to move this here, and I need to insert. Right. So imagine I have a piece of paper, and on that piece of paper, it's let's say I want to raise $1 billion, right? So I owe you $1 billion over a 10-year period. This bond will, oh dear Lord, why is it not wrapping? I'll just do this. Come with a, I don't know, what's interest rates at the moment? 5%, 5.33, so let's call it 5% coupon. This one will come with a 5% coupon, which means you will make 5% per year for the duration of the term, and then get your full principal back at the end of the term. I'm obviously putting this in baby talk, just at the end of the term. Interest payments will be done every 6 months. Sorry, what was that? I heard a question there.
Yeah, I wasn't sure what IOU stands for.
Oh, literally I owe you money. so I owe you. Yeah, so in England, like, we have like it's slang really, an IOU. Yeah. But a good question actually, yeah, sorry, that's just English slang there. So this is basically what a US Treasury note is. Now, a T-note will normally be a 2-year T-note, 10-year T-note, 20-year T-note, and guess what? They're that desperate. They're trying to get 30 to 35-year T-notes set up. So they then create this, and they will then try and sell this T-note. So I owe you $1 billion over a 10-year period. This bond will come with a 5% coupon, which means you make 5% per year for the duration of the term, and then your full principal will be paid back at the end of the term. Interest rate, yeah, okay, so that's what it is. Now, with a 5% coupon, I'm going to have to get my calculator out here. So what happens is, if they want to raise $1 billion, what is 5% of, I can't do maths, so that's 100 million, that's $1 billion, times 5%, 50 million, so it's 950 million. So if I was a buyer, so let's say Siam comes along, I've got $1 billion basically that I'm willing to give to the US hobo, the bankrupt hobo that can't afford to pay me. But what will happen is that first 5% will be represented in the buying price. So yes, this is worth $1 billion, what actually happens is I will buy this for $950 million, and that T-note comes to me. Now, this T-note has a coupon. A coupon is basically meaning, right, this will be the interest rate. So every year, I will make, what was it, £50 million or dollars per year, paid every 6 months. So it'll be like 25 million every 6 months. Make sense so far? Yeah? So I get all of the interest payments, and then at the end of 10 years, I get the value in a lump sum of that note. Now this note is $1 billion. So in 10 years time, I would have made 50 million times 10. So I would have made, what was that? 500, no, that's not right, is it? I've done that wrong. 50 million interest times 10, yeah, 500 million, yeah. So I would have made 500 million in interest, plus I get the billion back. Now, so that's the 10-year, and obviously the 20-year note is exactly the same. It's just a longer term. So, quick question. So, if you have a 2-year and a 10-year, which on a normal, everything's normal, what would have the highest interest rate? Would you think? Any guesses?
The longer it gets, the
Yeah.
higher the interest rate.
Yeah, it makes
More
sense.
risky.
Think of it like, yeah, exactly. Think of it just like a normal loan. Ignore that it's $1 billion. Let's say you want to lend or borrow £1,000 from a friend or whatever. If you're going to lend some money for a short period of time, you'll give them maybe a bit less of a yield. But if you're going to lock up money for 10 years or even 20 years, you want a higher rate because you're parking all that money. So that is normal period. Yeah, so that's normal. The 2-year will always normally be a lot lower in terms of yield than the 10-year. Now, has anyone heard of, well, in fact, before we go on to that, now, one of the craziest things about this whole setup is you have to go back to that vampire squid thing, but effectively what happens is you have the US Treasury, which is basically the US government over here. They're creating all these notes. So let's call them T-notes, because that's how they raise money. But here's the thing, the Federal Reserve, which by the way is not federal, has no reserve, and it's a private company that pays its shareholders 6% dividends per year, they are the main buyers of the T-notes. But what do they buy them with? So if it wants to raise, $1 billion, the Fed literally plucks out, or no, it types in their database $1 billion and effectively buys the T-notes from the government. That money then enters the US government. The US government is $1 billion in debt to the Federal Reserve. And so the way I imagine it is, imagine you have a lemonade store, outside your house, and you're a little child selling lemonade. It's like having your mother coming in, buying all of your lemonade every day, to the point where it looks like to your friends, oh my God, you're so good with your lemonade stand, you sell so much lemonade. Little do the observers know that it's actually your mum that comes in and buys all your lemonade every day. So the Federal Reserve plucks out the money out of its arse, gives it to the government. The government's in debt to the Federal Reserve, and that's what happens. And so what's going on with this chart? Not that chart. This chart here is that it's going to try and offload these mortgage-backed securities to some idiot somewhere. And it's going to use the proceeds to just buy up more of the US Treasury debt. So here, they're trying their hardest not to print new currency, but they're trying to add liquidity into the market without printing, if that makes sense. Because they're using the proceeds of selling these shitty mortgage-backed securities to then buy more securities. Now, also, I don't know if I mentioned this, going back to this, if the US is strong and dominant and prosperous, the rates of this will be very low. But if the world thinks the US is a basket case, guess what? The rates are just going to, ramp up. And it's another reason why, US interest rates have just been spiraling up because, shit's hitting the fan. And what is it now? 5.33, I think. So this is a way, just going back to this chart again, they're trying to add stimulus into the economy without printing more currency. So this is the first step, one of the many ways that they can do it. Eventually they'll go, oh, shit, there's nothing we can do. Let's just print. Which in reality is just adding 1 and zeros and pressing enter. Now, if shit hits the fan, rates go up. Yep, we've got that. Now, there's another issue here. So this is a normal situation where the lower rates, or the lower the term, the lower the rates. But sometimes we get an inverted yield curve. Now, you may have heard that in the news, but an inverted yield curve is where the 10-year is lower and the 2-year is higher. So what does that mean? That means the world, the market, which is the world, is going, ooh, I don't really want to lend you any money, America, because you look dodgy and I don't think you're going to be able to pay us back. So if I'm going to lend you money over 2 years, I want a higher rate, please. I think, yes, in the future, everything will be fine, but, you're going to war, you're trying to incite war in Ukraine and all that sort of stuff. You're being world police. Things are a bit rough. I don't want to really lend you money. So what happens is the 2-year goes absolutely nuts. And that is represented, the way you look at an inverted yield curve is the 2-year spread, 10 to 2-year spread. So this chart shows you so at 0%, it means the 2-year has exactly the same interest rate as the 10-year. So right now, let's just put this into practice. It's saying that the 2-year has a higher interest rate than the 10-year because we are a negative spread. So let's just get a thingy. So US 2-year note is 4.74. What's the 10-year? US 10-year note, 4.3. Look at that. So the 2-year, thankfully the examples worked here. So the difference between that and that should represent in that chart. So this is bad news.